the forces, because that forces the value of the currency to be stable. For example, Zimbabwe, he was experiencing, or right now, Venezuela is having too much, inflation over there. Their currency is very unstable. Similarly, with the Lebanon over there, their currency value is just unstable. So what if they peg to the dollar? And why dollar? Because dollar is the most stable currency, historically proven. If you see the history, the value of the dollar is very, very stable. So in order to stabilize their economy, their currency, they just peg to the dollar, right? So first, this forces their currency exchange rate with the dollar to be fixed. Second, their currency will move against non-dollar by the same degree as the dollar. So if the dollar is depreciating against pound, so your currency is also depreciating against pound. Even though you want your currency to appreciate against pound, but you peg your currency to dollar. If dollar is depreciating against pounds, your currency is also depreciating against pounds. So clearly there is a disadvantage here as well. But there is an advantage as well, because your country's currency is not very stable, or people are, or the responsible government people are fail to maintain the stability, so you peg. So you don't worry about the decisions, the financial decisions. You just, take this, tension or stress out that my currency will appreciate or depreciate. You just peg against the dollar. But look at that. You are following the country who is giant, financial giant. America has a financial giant. You have Wall Street and all this stuff. And you are a small country, right? So in that case, maybe the pegging is going to be affecting adversely after that, because it's really hard when you try to unpeg, right? Or the financial decisions of the Americans, they are directly affecting your economy as well. So maybe, okay, fine, the Americans gonna do what is best for them. If they appreciate the dollars, your currency will, unwantedly appreciate it. And what happened? You want to export something and your orders are rejected. Why? Because your product looks more expensive to outside world. And now what happened? Your country is now in more turmoil, right? So since the dollar is a more stable currency, it will make their currency more stable than the most one. Advantages, because dollar is more stable currency. So those countries who want to invest in dollars, they can invest in your country as well. Disadvantage, like I told you, weak economic or political conditions can cause firms and investors to question whether the peg will be broken or not. If the foreign investors fear that peg may be broken, they quickly sell their investment and convert their proceed into their home currency. Even the local residents may consider selling their local investments. Locals that are residing over there, they may sell their own houses and convert their money into dollars, so that whenever the peg is broken, we are not adversely affected. So converting their funds into dollar or some other currency. So these transactions place more downward pressure to their local currency, because people are not trusting their home currency at that time. So right now, the situation is that the Big Mac of McDonald's, which cost like $3 to $4 in US, it is now selling in Lebanon $20. $20 Big Mac. It's a huge cost for Lebanese as well. And people are not trusting Lebanese currency, they are trusting dollars. They want to convert their any saving, any penny, anything into dollars. So in that case, the country is more going deep down into depression. So the other disadvantage is countries have difficulty maintaining pegging. Yes, because political situation in America directly affect you. Plus, you have your own political instability as well, right? So you are not very political stable. That's why you peg. Plus, what if there's a turmoil in US? That is also causing you worse. So while country with a stable currency can attract more foreign investment, the peg exchange rate system could ultimately create more instability in a country's economy, right? Like you cannot compare your financial condition, your economic condition to the giant. You're a small country and you peg your currency with the US, what happened? US decisions will be beneficial for US citizen, not for you, not your for your scenarios. Maybe it will worstly affect you. So pegging agreements are Euro Snake Agreement, 1972, European Monetary System, EMS, that lasts from 1979 to 1992, Mexico pegging system, China's pegging system, Venezuela pegging system, like that. So these are the recent examples of pegging. Okay, so yeah, let's just talk about more pegging and then we will be having a break. So currency board used to peg currency value. So it's not like you are just pegging your currency against dollar. You can have a number of like 20% dollar or 50% dollar, 10% yuan, or rest of the 40% pound. So you can have an index as well. So who decide? It's a currency board. Your country's currency board decide that, okay, which country's dynamics looks more like ours and their currency is stable, so we can peg according to their currency, right? Interest rates of the pegging current countries. Of course, if the interest rate of the pegged currency increases, your interest rate also increases. Essentially, even if you are having a central bank, so that is a puppet. Simple, because he cannot do anything. You peg your currency to the other country's currency, so their state banks or central banks decisions gonna directly affecting your country. If they increase the money supply by printing more money, their value depreciated, so your value also depreciated. If their inflation increases, your inflation also increases. If they increase the interest rate, your interest rate also increases. If their country experience unemployment, your country also start experiencing unemployment, right? So exchange rate risk of a pegged currency is that the currency that is pegged to another currency cannot peg against all other currency. So it doesn't mean that you pegged with the dollar, so your worries are over. No, you pegged against dollar, not pound, right? Or you cannot peg to one and more currency. You can have a basket. Once you peg against basket, it doesn't mean that you apply for pegging some other currency as well. No. So exchange rate risk prevails. Yes. Why? What if you peg against dollars? What if dollars depreciate? Your currency also depreciates. So that doesn't mean that pegging reduces the exchange rate. Pegging your basically view is that we peg against more stable currency so that our currency is stable. But that doesn't mean that the exchange rate risk is eliminated zero. No, it's still there. Why? Because pegged currency, if increase or decrease, may causes your currency to increase or decrease in the same proportion as well, right? So it doesn't mean that pegging gonna reduce your exchange rate risk. Yes.
Teacher, I have a question. The
Sure.
pegging currency is only when you want to buy or sell on the exchange market, right?
No.
So you just give like a dollar equivalent value of your money. For instance, if the dollar is like if $1 equal to euro, my currency, 1 Florian equal to euro, right? So it's only on the exchange market. The rest, I'm by myself and the dollar is by itself,
Yes.
right?
It's like that.
Okay.
So you basically peg your currency, but it's not just pegging your currency. It's not just a small thing. Behind there is a huge, tons of information that you need to analyze, right? Because it will move against or in your favor depending on the condition of pegged currency,
And
right?
how can you have like every time the same data as the dollar, because you are not Central Bank of America? How do they know that they will always back up to the dollar?
The Americans don't need to be worried about that one. They will, make decisions for the best of the Americans, not for the best of the Venezuelan or Libyan if the Libya or Lebanon decide to peg. So they don't care about that. It's a currency board, your country, Lebanon or Libyan currency board, they will decide that we want to peg against dollar or not. Maybe they want to peg against yuan or maybe yen. It depends on their, right? So it's their basically their country's key in the hands of other country. That's it. You can say that.
Okay.
So all your financial decisions, you cannot do that because you pegged your currency, right? You cannot manipulate your currency. So pegged exchange rate systems still going on. Yes, some of the countries they already did that. Some of them they already got out, but some of them, yes, Bahamas. So Barbados, Bermuda, Hong Kong, Latvia, Saudi Arabia, right? So they already pegged to this kind of stuff. Some of them are because this data is a little bit old, but some currency already walked out from here. Like we talk about that. Venezuela got out of in 2000 and I think 2010 or maybe five. They got out from this pegging, but it's just for your information that yes, countries were pegging their currency against different ones. So you see, Tunisia, they pegged heavily against euro, 67%. Okay, in order to talk about dollarization, let's just talk about after a break. Okay, let's take a 10 minutes break
Yeah.
and then we'll start from here.
Also, teacher, a last question.
Yeah,
If,
sure.
for example, for Tunisia, everything related to uranium and the oil, it's sold by Euro, like their customers who buy and extract uranium and the natural resources paid in euro. So maybe it's better because they
Yeah.
have so much trade with European countries.
Yes, so that's why they peg their currency because their trade is in euro. So that's why they say, okay, euro is more stable to us and it is beneficial to us. So we peg our currency in euro and their weight is 67% over there, right?
Yeah.
So it depends on their currency board. Whatever they think is good for the company, they will peg that currency. It doesn't need to be dollar everywhere, every time. No, it can be pound as well. It can be Japanese yuan as well. But you need to see that whether your country's characteristics looks like more European, more American, more Japanese or not, right? Okay, let's just talk about after 10 minutes. We want to, let's have a break. Okay, welcome back after the break. Okay, so we already know about the fixed exchange rate system, free floating, managed floating, also called clean floating, and then we talked about pegging. Now let's talk about the dollarization. So this is not the exchange rate system, but this is a concept in which you are replacing your home currency with dollar. It means you are not issuing your currency, rather you are trading in dollars. So the replacement of a foreign currency with the dollar. So this process is a step beyond currency board, which is pegging. So in which you basically peg, you align your home currency with the dollar. But in this case, dollarization, you remove your home currency and you start trading in dollar in your local economy, just dollar. Although dollarization and a currency board both attempt to peg the local currency value, the currency board does not replace the local currency with dollar, right? In pegging,